You found the perfect home. It has everything you want: location, size, upgrades. But then reality hits. You start asking, can I really afford this house? What if the mortgage is more than I can handle? Are lenders giving me the real number or just what I qualify for? And here's the truth. Most buyers are approved for more than they can comfortably afford. And that's why so many feel house payments are crushing. What's up, everyone? I'm Brand the Mortgage Man. Over the last 23 years, I've helped more than 10,000 families realize their dream of homeownership. And today, we're breaking down exactly how to figure out how much house you can actually afford without relying on cookie-cutter rules or guesswork. By the end of this video, you'll know how to determine a realistic budget, include all hidden costs, and avoid becoming house poor. Here's the hard truth. When a lender pre-approves you, it's based on their risk rules, not your comfort. They look at your income, debts, and credit score. They calculate debt-to-income ratios. They ensure you can technically make the payments. But just because a lender says you can afford $500,000 doesn't mean you should. Affordability is about your lifestyle, your expenses, and your long-term goals, not just a number on a pre-approval letter. Here's the classic rule. Your housing cost should be less than or equal to 28% of your gross income. Your total debt less than or equal to 36% of your gross income. But that's a starting point. It doesn't account for real life expenses like utilities, internet, HOA fees, groceries, gas, commuting, student loans, credit cards, car payments, kids, pets, or future family expenses. The 28-36 rule is a good baseline, but real affordability requires deeper calculations. So start with the gross monthly income before taxes. That includes your salary, your wages, bonuses or commissions, averaged over 12 months, spouse or partner income if buying together, other consistent income like rental or side business. This gives you your financial foundation for affordability calculations. Next thing you want to do is list out your debts. You want to include every recurring debt, credit cards and their minimum payments, student loans, auto loans, personal loans. Total these for your monthly debt obligations. This feeds into your debt to income ratio. After that, you want to estimate your housing costs. And your housing costs aren't just principal and interest. They're going to include property taxes, homeowners insurance, mortgage insurance, PMI or MIP if applicable, HOA or condo fees, maintenance. I would budget 1% of your home value annually for that. So an example, $400,000 home, 6% interest, 20-year mortgage. Principal and interest is $2,860 a month. Taxes and insurance, $500 a month. HOA, $100. Maintenance, $333 a month, which totals $3793 a month. See how quickly those costs add up? Monthly payment versus sticker price is more important than just the purchase price. You need to determine a realistic budget. A good rule of thumb is that your housing cost should be less than or equal to 25 to 30% of your take-home income. If your net monthly income is $6,000, 25% will be $1,500, 30% $1,800. Compare this to your estimated total housing costs. If the home you want is $3,793 a month and you could comfortably spend $1,800, it's way too expensive. Affordability is about living without financial stress, not maxing out your approved loan. Next, you want to make sure you include future expenses. Think ahead. Kids or childcare, college savings, retirement contributions, emergency fund savings, car or home upgrades. Ignoring these can leave you house poor, living paycheck to paycheck just to make the mortgage payment. You need to run scenarios. Don't just pick one number. Run best, middle, and worst case scenarios. So as an example, if you have a home price of $400,000, which equals $3,793 a month, do a home at $350 for $3,250 a month, home at $300 for $2,700 a month. Now compare each to your comfortable housing budget. If your comfortable level is $2,500 a month, only the $300,000 home fits. This prevents emotional overreach in a competitive market. Let me give you a real example from my experience, because these numbers mean nothing if you don't see how it works in real life. A few months ago, I worked with a couple, Sarah and Mike Johnson. They were first-time home buyers. They've been pre-approved by a big online lender, one of those quick approvals that looked great on paper. The lender told them they should comfortably afford $550,000 home. On paper, that seemed fine. Their combined income was decent, their credit scores were okay, and the lender's debt-to-income ratio calculations said they were eligible. But here's the thing. They were living paycheck to paycheck. Their budget wasn't what the lender saw. Sarah had a student loan, Mike had a car payment, and they were also saving for a wedding. The lender didn't factor in things like groceries, utilities, HOA fees, future college costs for the kids they planned on having. So they came to me. concerned because the numbers didn't feel right. The lender had given them a number, but the stress in their gut told them something else. They wanted to know how much house they can actually afford. We started from scratch. Step 1, figured out their real income. We calculated their monthly income, which included Mike's salary, Sarah's part-time consulting work, and an average of Sarah's seasonal bonus payments. We averaged everything over 12 months to smooth out the highs and lows. Step 2, real debts. We listed every recurring debt: credit cards, student loans, car payments, even small things the previous lender didn't emphasize. We also added in their personal spending habits. The previous lender's system assumed a perfect minimalist lifestyle, which did not reflect the reality. Step 3, real housing costs. We calculated all housing costs, not just the principal and interest, the taxes, the insurance, possible HOA fees, maintenance, utilities, and small emergency repair fund. When we added all of it up, the $550,000 home became a $4,200 monthly commitment, way above their comfort level. Their gut was right. Yes, they qualified on paper, but living that way would be stressful. So we ran scenarios: a $500,000 home, a $450,000 home, a $400,000 home. Each included all costs: taxes, insurance, HOA, maintenance, future childcare, retirement contributions, and an emergency fund. By the time we ran the numbers, it was clear a $400,000 to $425,000 home was their true affordability range. They'd already fallen in love with a $525,000 home. Visions of painting the walls, hosting dinner parties, even planning the nursery. But running the real affordability calculation, it was clear that home would stretch them to the breaking point. They would have been house poor. Every month, a juggling act. Any unexpected expense could derail their finances. I could have just told them to borrow the max and hope for the best. Many lenders would have. But instead, we mapped out a step-by-step plan, targeted the $400,000 to $425,000 range, focused on loan type and down payment, and created a 12-month plan to improve cash flow. 6 weeks later, they found a $415,000 home in the neighborhood they wanted. It needed a little cosmetic work, nothing structural. Monthly payment, including all costs, $2,800, within their comfort zone. Leftover funds for savings, vacation, and wedding planning. And here's the kicker. Had they gone with the $525,000 house from the first lender, they would have been paying $3,600 to $3,800 a month, leaving almost nothing for extras or emergencies. That's the difference of $800 to $1,000 a month in disposable income. The difference between living comfortably and living stressed out. Their story shows exactly why pre-approval is not affordability. You can't just trust a number from a lender or online calculator. You need to look at actual income, real debts, future expenses, and lifestyle. And here's the part most people miss. This approach also sets them up for long-term success. By staying in a home they can afford, they started building equity right away and avoided high stress. They positioned themselves to upgrade in a few years without debt nightmares. Sarah and Mike even told me later, going with a realistic budget possibly saved their relationship. Seriously, money stress can sneak in and affect every part of your life. By staying realistic, they avoided that and started their homeownership journey on the right foot. So now that you heard that story, you need to consider some things. First is your down payment. Bigger down payment equals a lower monthly payment. Reduce or eliminate mortgage insurance. Build equity from day one. Even small increases save them hundreds a month. Next is how your credit score impacts everything. It impacts your interest rate, your mortgage approval, the PMI requirements. Better credit equals a lower rate, which equals a lower monthly payment and a higher affordability ceiling. The mortgage type can also impact things. A 30-year fixed gives you predictable payments. A 15-year fix gives you higher payments but less interest. ARMs, lower initial payments but more risk. For example, on a $350,000 home, a 30-year mortgage would give you a $2,100 monthly payment. A 15-year, $2,700. You need to be realistic and not greedy when looking for homes. Many buyers overestimate affordability. Don't max out your pre-approval. Consider lifestyle, not just house size. Factor in long-term goals. This is how you avoid financial stress after buying your first home. So here's a checklist for real affordability. 1. Calculate net monthly income. 2. Total all monthly debt. 3. Estimate full housing costs. 4. Include future expenses. 5. Run multiple price scenarios. 6. Factor in down payment and loan type. And 7. Adjust for comfort, not just approval. Figuring out how much house you can afford isn't about numbers lenders give you. It's about your lifestyle, future goals, and real cash flow. Follow these steps, avoid stress, make smarter choices, sleep better at night knowing your home truly fits your budget. Want more videos breaking down mortgage strategies, loan types, and first-time buyer tips? Hit subscribe and turn on the notifications.